All right, welcome back, everyone. Today we're diving into something that can make even the most seasoned investor a little uneasy:
Oh, yeah?
bear markets. We're going deep with a YouTube video. It's from Riqueza Vital. The title's a mouthful. It's O que es un mercado bajista 2024. Mercado bajista 2024. ¿Qué hacer ahora?
Catchy.
Yeah, right? But this isn't about hiding from the bear. We're going to understand it, figure out how to not just survive, but maybe even come out on top.
Exactly. Bear markets get this scary reputation,
Hmm,
but they're a natural part of how the economy works.
true. So let's get into it. The video opens with this dramatic image of a bear attacking, really highlighting that fear
Right,
factor.
but there's got to be more to it than just, the market dipping a bit.
Yeah, for sure. So what is result of a bear market, technically speaking?
So technically, it's when a major index, like the S&P 500, drops 20% or more from its highest point recently. But, smart investors are watching for signs before it even hits that 20%.
That makes sense. You don't wait until you're really sick to know something's up, right? Okay, so what are we watching for? The video breaks down a few things about bear markets: how long they last, how intense they are, and the psychological side of things.
Yeah, let's start with how long they last. It's not like a quick dip, which is more of a correction.
Mm.
Bear markets can drag on, like months, even years. Remember the dot-com bubble?
Ugh, don't remind me.
Well, that one lasted from March 2000 all the way to October 2002.
Ooh, that's a while.
Yeah, it shows why a long-term strategy is so important. You can't just try to jump in and out and time it perfectly.
Got it.
Yeah.
Patience is key. Now, what about the intensity? The video makes a point that not all drops are equal.
Right. Intensity has to do with how investors are feeling. If there's panic everywhere, even the assets that are usually stable can take a big hit. Think back to 2008. Even blue chip stocks weren't safe.
Wow, yeah, I remember that.
It shows how, during bear markets, things that are usually unrelated can suddenly move together.
So diversification, spreading your investments around, might not work as well then.
Diversifying is still super important, but you have to be smarter about it. It's not just about spreading across different types of assets. Think about different strategies too, like alternative investments that don't follow the market trends. Some commodities, for example.
Interesting. So you're not just trying to avoid losses, but maybe even finding ways to profit.
Yeah, exactly.
Okay, so that brings us to the psychological side. The video doesn't hold back on how scary it can feel.
Fear is a huge factor in the market. We tend to feel losses way more strongly than gains. It can make us do rash things, selling low out of fear instead of just writing it out.
And that fear, it can turn into full-blown panic, right? Like everyone's making bad choices at the same time.
Yeah. It's called behavioral finance. Crowds can make really irrational choices. Understanding those psychological traps is essential. Knowing your own biases, having a plan, and sticking to it.
Way easier said than done when your portfolio's shrinking. But the video does have some tips for spotting a bear market before it really takes hold, right?
Right. They break it down into three main triggers. First, economic causes. A recession, inflation going crazy, unemployment spiking, all bad signs.
So keeping an eye on the economic news isn't just for experts, it's for investors too.
Absolutely. The second trigger is geopolitical events.
Hmm.
Wars, political instability, even a really intense election. These things shake everyone's confidence and can cause sell-offs. Think what happened to the market after Brexit,
Yeah, that was rough.
right? So it's not just about the numbers, it's about what's happening globally too. The third trigger they talk about is financial bubbles,
Bubbles, like what?
like the dot-com boom. All that crazy growth based on hype, it eventually bursts. And when it does, the correction is brutal. They use that example to show how bear markets aren't always about external factors. Sometimes it's the market itself correcting its own overexcitement.
So a bear market can be like a reality check,
Exactly.
a necessary adjustment. Okay, so we've covered what bear markets are, what the warning signs are, what can trigger them. But the big question is, how do we actually deal with them?
Well, the main thing to remember is that a bear market isn't the time to panic. It's the time to be strategic. The video gives some interesting advice, not just on how to survive, but how to maybe even profit during a downturn.
Okay, now that I want to hear about.
The video starts with a simple but powerful idea: shifting your mindset. Instead of seeing a bear market as purely negative, view it as a buying opportunity. Think of it like a Black Friday sale for stocks.
Oh, I like that.
Yeah, prices are down, but the underlying value of a lot of companies hasn't actually changed.
So it's like stocking up on your favorite brands when they're on sale?
Exactly. But just like you wouldn't buy just any discounted item, you need to be selective. This is where fundamental analysis comes in. Look for companies with strong balance sheets, consistent earnings, and a solid track record. These are the ones that are more likely to come out stronger.
Makes sense. You're looking for quality that's just temporarily cheap because of the panic. The video also mentions defensive assets. What's the logic there?
Defensive sectors don't get affected as much by economic downturns. Think utilities, consumer staples. People still need electricity and toothpaste even in a recession.
True.
These stocks might not skyrocket in value, but they offer stability. And they often pay dividends, so you get some income during a volatile period.
Like a safety net for your portfolio.
Yeah.
But doesn't being too defensive mean you might miss out on the rebound when the market goes back up?
That's a good point. It's all about finding the right balance. You don't want to miss out on growth opportunities. That's why having some of your portfolio in growth stocks, even during a bear market, can be a smart move.
So it's about having a mixed approach, considering both risk and potential reward.
Exactly. Diversification is key. But like we talked about earlier, it's not just about spreading your bets across different types of assets. It's about diversifying across strategies, time horizons, and even geographies.
Now, the video mentions something called inverse ETFs as a way to maybe even profit from a bear market.
Yeah.
That sounds kind of risky, though.
They can be eight. Inverse ETFs are designed to move in the opposite direction of the market. So if the market goes down, an inverse ETF goes up.
Oh, interesting.
They can be useful for hedging, but they're not really for long-term investing because of how leveraged they are.
Leveraged meaning?
Meaning they can magnify your losses just as much as your gains.
Ah, got it. So probably not for the average investor. What about something a little less risky then? The video talks about using options.
Yeah, options can be used to either profit from a decline or protect your current investments.
Huh.
A put option gives you the right, but not the obligation to sell a stock at a specific price before a certain date.
So if you think a stock is going down, you can buy a put option at a price near where it's trading now. If the stock drops below that price, your option becomes valuable and you can sell it for a profit.
Exactly. And if the stock price goes up, you only lose the premium you paid for the option. So your risk is limited.
Okay, that makes sense. So options can be a useful tool, but again, it takes some learning and understanding before you jump in.
Definitely. Seems like the main theme here is knowledge. The more you know about different investment tools and strategies, the better prepared you are.
Exactly. It's about being a student of the market, always learning.
Absolutely. That's why the video emphasizes continuous learning. It's not about watching this one video and you're done. It's about staying informed about market trends, economic developments, and new investment strategies.
So it's an ongoing journey.
Yeah, and it's a journey with ups and downs, just like the market itself. But the more you learn, the better you can handle those ups and downs. Now, speaking of ups and downs, the video talks about the emotional phases of a bear market.
Right. It's not just about numbers and charts. It's about how we or reactee to them. The video describes it like a roller coaster denial, fear, panic, capitulation.
Yeah, it's a good analogy because it captures those emotions that investors go through. Denial is that first phase. We refuse to believe it's happening. We hold on, hoping for a quick rebound.
Like clinging to the hope that the coaster will suddenly stop going down and start climbing again.
Yeah, but when it doesn't, that's when fear sets in.
Right, as you see the losses piling up.
Exactly. We start to question our decisions and worry about the future. We might even start making impulsive moves based on that fear, like selling everything.
And that's where things can really get out of control, leading to that panic phase.
Panic is contagious. It spreads through the market like wildfire. Everyone's selling, driving prices down even further.
Yikes, it's like everyone rushing for the exits at the same time.
And then finally, we reach the bottom of the roller coaster capitulation. That point of complete despair where investors have given up and just want out no matter the price.
So you're saying even in the darkest depths of a bear market, there's a glimmer of hope. But how do we avoid getting caught up in all that emotion and making those bad decisions?
The video gives some good advice. First, recognize those emotions are normal. Everyone feels them. Don't beat yourself up.
It's okay to be scared.
Exactly. Second, stick to your plan. Remember why you invested in the first place and what your long-term goals are. Don't let short-term stuff derail you.
Stay focused on the big picture.
Third, stay informed, but don't obsess over the news. All that negativity can make your fear worse. Focus on facts, not hype.
Check the news, but don't let it consume you.
Right. And finally, if you're feeling overwhelmed, don't be afraid to get some professional advice. A financial advisor can provide objective guidance and help you stay on track.
So it's like having an experienced guide to help you through the tough parts. Now let's shift gears a bit and talk about something the video touches on briefly, but I think deserves more attention: sector analysis. It seems like knowing which sectors do better during a bear market could be a real advantage.
Absolutely. Sector analysis is a powerful tool, especially during times like these. It's all about understanding how different parts of the economy react to change.
Mm.
Some sectors are more cyclical, meaning they do well when the economy is booming, but suffer when things slow down.
Like what kinds of sectors?
Think consumer discretionary. Things people buy when they're feeling good about the economy, like new cars, vacations. Those industries take a hit when people start tightening their belts.
Right, makes sense. And then you have the defensive sectors, the ones that provide essential goods and services.
Exactly. Things like utilities, healthcare, consumer staples.
So during a bear market, it would make sense to shift more towards those defensive sectors?
It could be a good move, but it's not as simple as just buying any stock in those sectors. You still need to do your research, look at individual companies, analyze their financials, understand their competition.
So it's about being selective within those sectors. So besides cyclical and defensive sectors, are there any other categories to be aware of?
There's a category called counter-cyclical sectors that actually tend to do well during economic downturns.
Oh, really? So they go against the trend? How does that work?
Think about gold. It's considered a safe haven asset. So when investors get scared, they buy gold, which drives up the price. Some discount retailers also do well during recessions as people get more price conscious.
So it's about understanding the unique factors that drive certain sectors. But how do we know which sectors are likely to do well or not?
The video mentions using charts and data, which is a great start. Technical analysis can help you spot trends, see potential turning points, and get a feel for the overall sentiment.
So combining that with fundamental analysis of individual companies.
Yeah, it's about looking at both the big picture and the individual details. It can seem like a lot of research.
It does.
But remember, knowledge is power. The more you understand, the better decisions you can make. And remember, you're not alone. There are resources out there to help.
Like financial advisors, research platforms, even podcasts like ours.
Exactly. And don't underestimate talking to other investors. Sharing insights and learning from each other can be really valuable.
It's like having a team of explorers venturing into the unknown together.
Now, the video also talks about the importance of understanding how economic recoveries happen. It's like trying to predict the weather, difficult but crucial for making informed decisions.
So if you know a storm is coming, you can prepare for it. What are the signs that a recovery might be on the horizon?
Well, the video mentions a few key things. First, we look for the decline to start slowing down and the market to stabilize.
So like the roller coaster leveling out at the bottom?
Exactly. Then we look for signs of economic growth picking up. This could be GDP going up, unemployment going down, consumer confidence rising.
Like seeing those first signs of spring after a long winter.
Yeah. And finally, we look for investor sentiment to shift. Stock prices rising, trading volume, increasing more positive news coverage.
Like the clouds parting and the sun coming out.
Exactly. But remember, economic recoveries are rarely smooth. There can be setbacks, volatility, and false starts.
So it's not about timing the market perfectly, but about recognizing the signs and positioning your portfolio accordingly.
Precisely. And that's where sector analysis comes in again.
Yeah.
As the economy goes from recession to recovery, different sectors take the lead.
Oh, interesting. How so?
Early in the recovery, cyclical sectors often do well as consumer spending picks up and businesses start investing again. Then as the recovery gains, steam growth sectors like technology and healthcare often take center stage. And in the later stages, defensive sectors like utilities and consumer staples may provide stability and income.
So it's like a cycle of different sectors taking turns leading the way.
Exactly.
Yeah.
Understanding these patterns can help investors position their portfolios to capture potential gains throughout the recovery. Now, the video talks about the psychology of a bear market, but it doesn't really give much practical advice on how to deal with those emotions.
Right. It's one thing to know fear and panic are normal, but it's another thing to actually manage those feelings when you see your portfolio dropping.
So beyond just recognizing those feelings, what can investors do to stay calm?
Yeah, what are some actual strategies?
Well, one of the best things is to focus on the long term. Remember your overall goals and don't let short-term market swings change your plan.
Keep your eyes on the prize.
Another helpful strategy is to diversify your portfolio. As we talked about before, spreading your investments across different things can help reduce volatility.
Like having a backup plan just in case.
Exactly. And finally, don't hesitate to get professional advice. A financial advisor can give you objective guidance, help you stay disciplined, and keep you focused on your goals.
So it's like having a coach to guide you. Now let's go back to the video for a minute. It has a section with common questions about bear markets, and I think it's a good way to review what we've learned.
Yeah, I agree. Hearing those questions and answers can really make things click. So the first question is a pretty basic one. How do we actually know when it's a bear market?
The video mentions that 20% drop from peak prices, but it also says that a real bear market is more than just a quick dip. It's a sustained trend.
So we're looking at both the size of the drop and how long it lasts.
Right. And the video goes on to list the key characteristics of a bear market.
Like a checklist for spotting a bear.
Exactly. It highlights falling prices, of course, but also a decline in investor confidence and an increase in market volatility. Think back to those crazy swings we saw during the early days of the pandemic.
Yeah, that was wild.
That's a classic sign of a bear market in action. Then the video tackles a practical question: what financial strategies are recommended during a bear market? It repeats some things we've already discussed. Diversifying, holding on to some cash, looking for companies with strong fundamentals.
Like getting ready for a financial storm.
Right. The video also says it's important to review your portfolio and make adjustments. It's not a set-it-and-forget-it situation. You need to actively manage your investments, especially when the market is turbulent.
It's about being in control. Now, the video also explains the difference between a bear market and a bull market. It can be confusing to tell them apart.
It's a key difference. A bull market is all about rising prices and optimism. Investors are confident and things are looking up.
Like a party in the market.
Exactly. But a bear market, as we've been talking about, is the opposite. Falling prices, declining confidence, and a sense of pessimism.
So it's like the party's over.
Right. And the video doesn't shy away from the big picture. It talks about how a bear market affects the overall economy.
So it's not just about investors, it affects everyone.
Yeah. As stock prices fall, investors get more cautious. Businesses might delay investments or cut back on spending, which can slow down the economy and even lead to job losses.
It's a good reminder that what happens in the financial world has real-world consequences. Now, the video also explains the difference between a bear market and a market correction. Yeah, those terms get thrown around a lot. What's the key difference?
A market correction is a short-term decline, usually 10% to 20%, that happens quickly and is often followed by a rebound.
So it's more like a blip on the radar?
Exactly.
Yeah.
While a bear market is a much longer period of decline with a bigger drop.
So it's about both the size and the length of the decline. Now, I really like how the video ends with a call to action. It encourages viewers to take what they've learned and actually use it.
Yeah, it's all about putting that knowledge into practice. Understanding bear markets is great, but using that understanding to make decisions is what matters.
That's like having a map, but never actually going on the adventure. The journey is where the real learning happens.
Exactly. And sometimes that journey takes us through some tough terrain like those bear markets. But remember, even the most experienced adventurers face obstacles along the way.
It's all about how we overcome those obstacles. Now let's dive into the world of sector analysis, something the video touched on briefly.
Sector analysis is a key tool for investors, especially when dealing with a bear market.
It's like knowing which plants do well in different environments.
Exactly. Different sectors react differently to changing economic conditions. Some sectors, like healthcare or consumer staples, tend to be more resilient during downturns,
Like strong trees that can weather a storm.
while others, like technology or discretionary spending, might be more vulnerable.
So knowing which sectors are likely to do well or not during a bear market can give investors an edge.
It's all about positioning your investments based on the economic climate.
Now, the video briefly talked about using charts and data to identify sector trends.
Charts and data are like the tools that help us understand the market. They show us historical patterns, potential turning points, and future movements.
So it's like using data to make informed decisions.
Exactly. And don't forget about staying up to date on economic news.
Keeping your finger on the pulse.
Things like interest rate changes, inflation reports, and government policies can give you clues about the economy and which sectors might be affected.
So it's about connecting the dots.
And of course, sector analysis goes hand in hand with diversification.
Don't put all your eggs in one basket.
Spreading your investments across different sectors helps to balance risk and potentially improve returns.
Now let's get back to the video's emphasis on doing your own research.
It's crucial. Informed decisions are the best decisions.
It's easy to get caught up in the hype or follow the crowd, but the best decisions are the ones that align with your own goals, risk tolerance, and time horizon.
And remember, you don't have to do it alone. There are resources out there to help you.
Absolutely. Financial professionals, reputable sources of information, and even podcasts like this one.
The financial world is always changing, so staying curious and informed is key.
And as you continue learning, remember to be patient and disciplined.
Especially during those tough bear markets.
It's easy to get emotional, but remember, investing is a long game.
It's not about timing the market perfectly. It's about having a solid strategy and sticking to it.
Well said. And just like a tree needs time to grow, So do our investments. Before we wrap up this deep dive, I want to leave our listeners with one last thought-provoking question from the video.
It asks, if a bear market hit tomorrow, what sectors would you feel confident investing in and why?
Well, we've talked about consumer staples being a safe bet.
Yeah, people still need those everyday things, even when the economy's not doing great. Food, drinks, household stuff, those sales tend to hold up.
Right, but it's not just about picking any company in the sector, right? You got to look at their financials, market share, how they adapt to changes.
Absolutely. It's those details that matter. Like a consumer staples company that's known for low prices might do even better during a recession than one selling luxury items.
Oh, that's a good point. You really got to do your homework. What about healthcare? The video mentioned that as a potentially strong area too.
Healthcare is interesting. It's driven by need. People always need medical care, but also by innovation. New technologies, treatments, that creates opportunities.
So you've got that balance of stability and growth potential. But yeah, we'd still need to look at the individual companies.
Exactly. That's what makes this question so interesting. It's not just about picking a safe sector. It's about understanding what's happening within that sector and finding those companies that are built to last no matter what the market does.
Like finding those hidden gems, the companies that can not only survive, but thrive during a downturn.
That's what smart investing is all about. Knowledge, analysis, a bit of curiosity.
Well said. This deep dive has given us a lot to think about, not just how to get through a bear market, but maybe even use it to our advantage.
Bear markets are part of the cycle. They're tough, but they also create opportunities for those who are prepared.
So to everyone listening, stay informed, stay curious, keep learning, and until next time, happy investing.